Hey everybody, good evening. Marty Missouri here, March 21st, 2017, your weekly video. Not going to do the client presentation this week. It's a little redundant, doing a lot of the same stuff the last 3 weeks in a row. And besides, today was a special day, as you probably noticed. The major averages were down over 1%, first time in over 5 months, and that is, I promise you, an unusually long period of time for such an event, historically speaking. In front of you, the S&P 500 index, 29 points down today, 200 and something on the Dow. So yeah, ugly day, and at least in very recent history, something that we've kind of grown unaccustomed to. The narrative, the media is always trying to explain it away. Today's narrative was that Republicans are warning party members that if they don't give them repeal of Obamacare, it may be a tough call to get a massive tax cut. Maybe the market's been relying on that. So some threatening words from one Republican to the next in terms of getting the healthcare reform done that they're looking for. And as you might imagine, with the narrative being so bullish for the market based on tax reform, deregulation, and so forth, today might upset the markets. Again, I always maintain that there's too many factors to really know, but let's go ahead and go with the media's explanation today for lack of something better. And by the way, we don't need to explain away market volatility, but here's what happened in the sectors. The things that have been working very well didn't work at all today. In fact, everything got turned upside down. Financials, which happens to be our largest exposure, was the worst performer. Tech, materials, industrials, energy, healthcare. The real conservative stuff did better. Utilities actually went up on the day. But despite that narrative, the setup, the short-term setup, had been deteriorating. Here is the moving average convergence divergence, which I've shown you a lot over the last year or two. And this is an indicator a lot of technicians like. When the white line drops below the red, that's a sell signal, and you can see the market giving up some steam here. On a short-term basis, I like the 5-day exponential moving average up against the 10-day. These put greater weight on the nearer term. That's the exponential. And when the red drops below the yellow, that is a sell signal, and that happened today. And I promise you, a whole plethora of technical indicators gave sell signals today, if not before today. So despite today's big political threat, there was some short-term breakdown in the market already. Question, of course, being, is this volatility to pay attention to or volatility to ignore? I've been showing you the setup in 2017 and how similar it looks to the setup in 2013, which was our last really good year where we had a 29% gain. Look at the red and the yellow. Those short-term sell signals happened many times. Happened with the MACD, happened with my indicators here. And unless you're very, very nimble, you could have got what we call whipsawed and lost a lot of money trying to trade these indicators. So while traders do it, short-term traders in particular, I would say don't try it unless you can do it full time and you study it a lot, you back test it, and you get a lot of history and experience under your belt. For most of us, that's not a game we should play. Most of us are long-term, more patient investors. And again, these short-term signals can be dangerous, to say the least. What we try to do as long-term investors is smooth it all out. Here's a monthly 20-year chart. I left the 5 and 10-day periods on there, but they become monthly periods. So the 5-month moving average up against a 10-month moving average for more patient, more calm investors. This isn't a bad indicator. As you can see, there was nothing in the late 90s that said you should bail out of the market or even get very defensive until right at the peak when the tech bubble burst. Then these indicators gave us a big, strong sell signal. The longer-term moving average rolled over decidedly, and you had a real serious bear market there. Early on in the recovery, you got the buy signal, and it stayed there all the way until the real estate bubble, or I should say the mortgage bubble burst. And then we had a very serious recession and downturn, and a little ways after we started to recover, you got the buy signal in there again, and you had some wavering. Here you had your 10% correction in 2011. You had a rollover there for a while, but it quickly recovered, so it could have been dangerous to try to trade that. Had those two back-to-back 10% corrections in mid to late 2015 and then early 2016, but not a very serious rollover that told you you should be looking to get very defensive. And here we sit today with those longer-term, smoother moving averages looking a lot more like periods like this as opposed to periods like this. So again, we need to be patient when we're thinking long term. If you prefer a daily chart and using the 200-day moving average, which is the favorite of many long-term investors and traders, as you can see, you didn't get that decisive rollover that would have told you to get defensive until you got into that bubble bursting, tech bubble bursting. And then here you are recovering, signals that would say you should be in the market. A lot of support the price found against that 200-day moving average, rolled over again during the mortgage crisis, came back, and while you had some threats, you never really had anything that was sustainable in terms of a downtrend. And now you have a very solid upward sloping trend in the 200-day moving average, telling us to stay with our current course, if you will, or our current plan. If you want the more sensitive 50-day moving average, I've shown that a lot over the years. A lot of traders like that. They sell the market when it crosses over, but even that can be precarious and give you some whipsaws and can lose you some money. So again, pay attention to the 20-day. If you like the 50-day, is there something there that may tell you that you might start thinking about changing the allocation? Or we here, if we manage our money, would start thinking about it? Certainly nothing there, even when you look at the 50 and the 200-day together as of today. The sectors, again, absolutely got hammered. So here's that same illustration. So when we look at it sector by sector and we use those longer term, more smooth, patient, if you will, moving averages, nothing in the financials in the 50 and the 200-day would tell us to worry. We've got good upward slopes with the 50 on top. Technology is a 15% target. By the way, financials is a 20% target currently for us. 15 to technology, 15 to materials, 15 to industrials. All these tell us to stay the course. Energy, now normally in a situation where the economy is sending the signals that it has, we might have a 15% upward target to energy, but we kept it at 10. There's a lot of uncertainty in that environment and so forth. I do like energy in this economic environment. However, our indicators are tell us to go cautiously, if you will. Healthcare, a defensive sector. We did just recently up our target to 10% from 8 because I like the looks of the healthcare chart. It's actually been trending much better of late. We're still staying zero REITs. REITs are very interest rate sensitive. This is a very ugly chart. The 50 days below the 200, they're both sloping down, with notwithstanding the recent little better look in the 50-day. Staples, we have an 8% target, looking better. We would expect staples to underperform in a faster growing economy, but it doesn't mean they have to lose money. It doesn't mean we shouldn't have some defense in the portfolio, like healthcare and like our 8% target to staples. We don't have any money targeted to utilities. Now, I know utilities have been doing much better. They are exceedingly interest rate sensitive. So if we are indeed moving into an economic acceleration with a little higher interest rates, as a longer term trend, utilities would still be something to avoid. We will get there ultimately. We just don't think it's time to get there just yet, but we'll remain open-minded and we'll pay very close attention to our indicators. Question being then, of course, and I've already answered it, is should we be doing anything differently than what has been working since before the election the last 6 months? And that's financials, industrials, tech, materials, and so forth. The more cyclical sectors are doing better. This may be just a consolidation phase. We'll wait and see, and we won't consider any adjustments until we have more evidence and more data that tells us to do so. The trends that we've seen in sectors over the last 6 months is consistent with what we're seeing in many of the economic indicators. This is just one. It's the Citigroup Economic Surprise Index, which basically tracks actual economic data as it comes out relative to what economists had expected. When this is going up, the economy is doing better than what folks had anticipated. The quote I sent out to you earlier today, I want to repeat: for every correctly called market top or bottom, there are dozens, if not hundreds, of inaccurate calls that lie scattered in the graveyard of market analysis and in personal trading accounts. Some destroy their accounts by stubbornly fighting the trend. The trend, once established, has greater odds of continuing than reversing, and that's what happens to these folks here who play these games. I'll say it once again: if they're not nimble, if they're not very astute and have more indicators than just these to rely on, they can get utterly creamed playing the short-term game in the market. So we won't do that here. And folks, I'll leave that there for this week. Thank you as always for watching and listening. Look for my weekend message here in the next 3 or 4 days. Take care. Bye-bye.